Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and I'm Alex Matthew. This is where we get you actionable insight that helps you manage your mutual fund investments. Now, when it comes to choosing the right mutual fund schemes, a good approach to have is to decide based on your goals, how much you need to achieve those goals, and when do you need that money by. To that end, we're going to be talking about shorter term goals. What is the definition of that? And how do you plan those investments? Because quite often, those short-term goals are non-negotiable, or at least you wouldn't want to push them further down the line. To talk about the investments that you need to make in order to achieve those goals, I'm joined by Mrin Agarwal, who is financial educator and founder of FinSafe India, as well as Vishal Dhawan, the founder and chief executive officer of Plan Ahead Wealth Advisors. Thank you to the both of you, Mrin as well as Vishal, for joining in and for taking the time. I will start with you, Mrin, just to get a sense of what you normally define as short term, and how should people go about planning these investments?
So good afternoon, Alex, and it's lovely to be here today. Well, short term essentially means goals, in my definition, of below 3 years. So it could be anything ranging from a day, a month, 3 months, 6 months, a year, 2 years, or 3 years. And ideally, for this sort of a goal time frame, given the volatility in the equity markets, it's always better to invest in debt funds, which basically invest into bonds. Now, within the debt funds, you have various different categories which cater to different time periods. So, for example, you have the liquid funds, which you can do up to a month. And then you have the ultra short duration funds, which you can do for about, let's say, a month to 6 months. And then you also have the low duration funds, which can be done for 6 months to about 2 to 3 years as well. So these are pretty much the categories. Once you do have a 3-year time frame, you can consider short duration debt funds as well. So this is pretty much the spectrum of what's available on the mutual fund side to plan for short-term goals.
I'm curious about, Vishal, whether you have another definition, or you more or less think about short term as 3 years, or is it shorter than that?
I think that's a great question because clearly that's very, very different. Our sort of experience on short-term goals tends to be more things that are coming up in the next 12 months in the way that we look at it. I think anything between a year to 5 years we sort of categorize as more short to medium term, depending on where in that spectrum it is. So I think a lot of what Mrin mentioned, for example, I think is relevant even if you have up to 1 year goals. I think there might be just an addition, which is essentially arbitrage funds, which, even though they're not classically debt mutual funds, are a category that have seen a lot of traction over the last couple of years, especially once the tax treatment on how debt funds were treated actually changed. So I think a lot of the categories which Mrin mentioned, plus arbitrage funds, could possibly be categories that could be looked at.
Absolutely, and
I'm glad that you, up to 1 year, or as Mrin.
Yeah, I'm glad that you pointed out arbitrage funds, because I secretly wanted to slip that in. I wanted you to talk about it, and we will talk about how these funds work, because a lot of people are unfamiliar with it. To a certain extent, they know about liquid funds because we've been talking about how that can serve as your emergency fund, and you would put money into these even if you were to, for example, use it to divert funds over a period of time into equity through the systematic transfer route. But let's talk about how to go about. First of all, let's talk about arbitrage funds. Mrin, I'll come to you on this one, because what Vishal was just pointing out was that over the last couple of years, a lot of people have gravitated towards arbitrage funds, because now all capital gains that emerge from fixed income mutual fund schemes are now treated as short-term capital gains, and they are taxed at slab rate, whereas arbitrage funds, because they're equity, are taxed based on the equity taxation. But how do these funds work?
So arbitrage funds basically buy shares in cash and sell it in futures, and this is a simultaneous transaction. They can have about up to 35% in bonds as well. So when they do the arbitrage transaction, whatever is the difference in the price is essentially translating into the return. And generally, if you see, the returns are going to be tracking the short-term yields as well, right? So this is pretty much how they work, and they help in basically they reduce the risk by completely hedging the equity exposure. And I mean, of course, they have become very popular, and the returns have also been very good in the last 1 year or so, which has led to a lot of inflows into these funds, driven by the fact that they do carry a lower rate of taxation. So for somebody in a 30% tax bracket, even if you hold it for less than 1 year, you're paying 15% versus having to pay 30% plus in case of debt funds.
I'm curious, Vishal, Rin just pointed out that these funds, quite a few of them, have done reasonably well. What is the variance when it comes to the performance of these schemes, and is there anything based on the prevailing conditions that would affect the range that you would expect the returns to come in?
So there's very clearly, bull markets that we've seen over the last year or so. And typically what happens in bull markets is spreads actually become wider. And when spreads become wider, arbitrage funds tend to do better. So I think the exact opposite of that, which is a bearish market, which could get triggered by multiple things, whether they're domestic or international, could actually narrow those spreads down. And all of a sudden, those past returns that everyone's talking about may not look as attractive anymore. So I think the important thing for investors to keep in mind when they're buying arbitrage funds is threefold. One is ensure that you're putting in money there where you have at least a 3 to 6 month investment horizon. Don't substitute a liquid fund with an arbitrage fund or an overnight fund with an arbitrage fund. You need to do that with a sort of at least a 3 to 6 month investment horizon to get through phases where you might see bear markets. Now, in bear markets, what the fund managers may choose to do, if the futures, for example, is at a discount to cash, is park the money in debt and not park the money in equity at all, or use deposits to park the money in that interim period. And when that happens, because some of the arbitrage funds could have a slightly higher expense ratio as compared to what a liquid fund might have, for example, the returns may be actually lower than what you would make off a liquid fund. So I think you need to be mindful of that as a risk when you're buying an arbitrage fund. I think the last 1 year's returns may not be completely the best way to project forward, because there is a bull market that we've seen actually there.
Okay.
The second thing that you need to keep in mind is that if your tax bracket is not very high, then maybe that differential might not be as attractive as it may appear to be as if you're in a high tax bracket. So if you look at the past 1 year, for example, you'd notice that the differential on post-tax returns could be anywhere between 1.5% to 2% in the categories. But that may not sustain, and obviously that may not be possible if you're in a low tax bracket, because it doesn't make it that much more attractive.
So we're talking about...
The third thing, which I think investors need to be...
Please go ahead.
And the third thing investors need to be mindful of is also that some of the arbitrage funds could have exit loads attached to them as well. And therefore, you need to be aware that, if you put in your money there and suddenly your liquidity need changes, because let's say you parked emergency money there, or you've parked something which you thought was required in the next 6 months to a year, and all of a sudden you need the money in 15 days. You might have an exit cost attached to it. So I think investors need to be very mindful when they're putting money in there, rather than just looking at past returns and making the decision to go towards arbitrage.
Yeah, that's a very important point. And in fact, the post-cost return, not just the post-tax return, is something to take into account. Now, Mrin, having said that, unfortunately, the reality of the industry that we're talking about and the products that we're talking about is that the very recent performance is what generally leads to people making decisions, which is why I'm very keen on having this conversation today. We have seen a significant run up over the last 12 months to 18 months in the equity markets, and as a result of which you've seen arbitrage funds work in a certain way. That's perhaps spoilt the expectations of a lot of investors, and people are looking at it more favorably as an alternative to liquid funds and overnight funds. Is this the right approach?
Oh, no, absolutely not. And as detailed by Vishal, the spreads basically move based on flows. Of course, if there are going to be a lot of flows coming in, it also depends on the number of opportunities available and the market direction as well. And he also talked about the costs as well. Also, remember that when you look at overnight and liquid funds, these are meant for much shorter term periods. You're looking at this for a maximum of about 3 months. Whereas when you're looking at arbitrage funds, these are ideally meant for longer term periods because of the fact that you might have volatility or you may not have those trades available in certain times. And that's why we typically recommend to hold arbitrage funds for at least 6 months to a year and not really look at it for below 6 months. So certainly do not move monies which you need in the next up to 3 months to arbitrage funds.
Okay, fair point. Now, when it comes to choosing the right scheme, now you've specifically said that if it's more than 6 months, you should look at arbitrage funds, or you could look at arbitrage funds. But when you're selecting both liquid and overnight funds for sub 6 months requirements and arbitrage funds for over 6 months requirements, how do you choose the right scheme, Rin?
Yeah, so I mean, for me, it's always been like when you look at any fund, first it has to tie in with the time frame that you have to your goal. That's paramount, of course. The second thing is also to look at, when you're looking within fund houses, of course, it's really dependent upon the consistency of returns that you have seen some of the schemes giving. And I always look at rolling returns when I compare schemes. So in fact, I've shared some data on point-to-point returns versus rolling returns, and you'll see the stark difference, right? So today, a lot of people are looking at investing in arbitrage funds, looking at that 7% plus return that's been generated in the last 1 year. But when you actually look at the rolling returns between, for example, an arbitrage fund or, for example, an ultra short duration debt fund, you'll see the returns are pretty similar, right? So in the last 1 year, for example, the arbitrage fund on a rolling basis has given you 5.36% per annum, but the ultra short duration has given you 5.29% per annum. And that's it gives you a clearer picture of the returns. Even when you look at the returns on the longer term to assess fund performance, or even to assess whether you want to get into an ultra short duration fund or a low duration fund versus getting into an arbitrage fund. I mean, keeping the tax part of it aside, I mean, if you're just comparing these schemes, you do need to look at the rolling returns, and you will actually see that on a 3-year basis, the rolling returns of the low duration fund and the ultra short duration fund is actually better than that of the arbitrage fund. So I think, these are some parameters that one needs to consider. Of course, the time frame that you have to the goal and the consistency of fund performance and really looking at rolling returns.
Okay, that's a fair point. Now, we've got Vishal back with us. Vishal, we've spoken about how you would ideally look at investing in these, and the point well taken. If you have requirements for funds above 6 months and perhaps up to a year, you would look at arbitrage funds. Is there something that you'd like to add in terms of how you select a fund in this particular category?
So I think three things very clearly that we focus our efforts on. One is, like Min mentioned, consistency and best measured through rolling returns. Second is expense ratios, because that makes a big difference. Clearly lower, the better. And the third is look at your exit loads. Shorter periods work well because we do find that goals end up changing sometimes, and you do want to avoid an exit load if it's possible. Okay. So I think those are three things that investors need to look at very carefully when they're making choices.
Now, I'm not asking you to make recommendations, but if you were to narrow it down, the field, and would talk about schemes that you have watched very closely, both of you, in the arbitrage category and also in the liquid and short-term category, overnight category. I'll come to you first, Vishal. Are there any schemes or fund houses that you've looked at very closely?
So we have. So there are players like Kotak, Edelweiss, Invesco. I think they've been fairly decent in terms of the way that they have worked on the arbitrage side. So these are three sort of players that we look at very closely on the arbitrage space.
Okay. Rin, is there anything that you would like to add? Do these conform with what you've looked at as well?
Pretty much. So I would say Kotak or ICICI on the arbitrage side.
And anything on the fixed income side?
Well, on the liquid side, of course, I like most of the ICICI funds on all liquid, ultra short term, and short term categories. So IDFC low duration on the low duration side, or SBI overnight. So these are a couple of funds that I like.
Vishal, on the fixed income side?
So I think on the liquid side, ABSL is a liquid fund that we look at. We also look at Nippon. And similarly with the low duration ultra short, I think ICICI is definitely a fund house that we look at.
Okay, fair point.
Would look at carefully portfolio.
It is time to take a few of the questions that have come in from you, the viewer. And I must say that I'm quite impressed with the quality of the questions that have been asked. It means that people really understand the space and are understanding more about investing as well. The first question is from Ram. Ram is 33 years old and he's got 60% portfolio exposure in PPFAS, that is, I would assume that it's the flexi cap scheme, and the rest in direct large cap. He would like to add one or two more mutual fund schemes, but even having 3 mutual fund schemes, he says, would be, in his opinion, over diversification. What should his approach be as a long-term investor? His current value of investments is 23.7 lakh rupees in Parag Parikh Flexi Cap Fund, as well as 5 lakh rupees in Parag Parikh Tax Saver Fund. I'm assuming the rest is in large cap equity. Mril, I'm coming to you on this one. I know that we preach very often that you should not have too many schemes. I guess having too few schemes is also not a good idea. He thinks that that having 3 schemes would be over diversification. Is he right? And second, which schemes would you advise him to have?
So, diversification is not only based on the number of schemes that you have, but also in the style or the market cap that you're following. So when you look at both the schemes that are there, they're from the same fund house, and hence they'll have the same style of management. There is a 65% overlap in the stocks held in both the schemes, which is very high. So you might as well have just had one of them. Possibly the tax saver was done for tax saving purposes, but it's really not giving you any diversification at any point if 65% overlap is there. The second thing is that if the rest of the portfolio is in direct stocks on the large cap side, again, when you look at the PPFAS FlexiCap, for example, it has about 40-45% exposure to large cap. So there might be some overlap there as well. So I think it's very important for Ram to actually diversify into mid cap or small cap funds based upon, of course, I'm presuming that he's going to be able to hold for the long term, and based on his risk profile, if he can, he should ideally look at some mid cap funds like, for example, Mire Mid Cap. And on the small cap side, I would recommend Nippon Small Cap.
Interesting. Okay. Do remember that Nippon Small Cap, you can only do SIPs now because it has stopped lump sum investments. Do you have anything to add, Vishal, and would your fund choices be different?
So I think there are 2 additional elements that I would like to add on to. So one is, I think, the need to combine active and passive together. I think if you're creating long-term portfolios, it's a good idea to have some allocations to index funds. And that would be an important element in here, even though he might have a large cap direct equity portfolio, because clearly that is still an active strategy. The second thing is to also look at adding some international exposure, because I think one of the things that does tend to happen, especially when you have the sort of significant India story that's getting talked about, is that you tend to go overboard on just having all your money lying in Indian equities only. And while PPFS has a little bit of exposure, because of some of the caps that exist there, the effective exposure has come down quite significantly. So I would suggest that a combination of adding in some index and some exposure to international funds might be an important idea.
Okay, so something like a NASDAQ ETF, would you say?
Yeah, maybe S&P 500 going through an SIP, because that's possible. I think the NASDAQ one is very concentrated and therefore less preferred.
Yeah, and the kind of run-up that it's seen over the last several months. Let's talk about Manoj Gupta's question. He is 61 years old and he's got, I would think, a sizable corpus Because he's saying that he wants to invest 2 crore of that corpus over the course of the next 2 years from his retirement fund and eventually start an SWP of 1.2 lakh. Can you recommend a few funds? So his requirement, I would think, on an ongoing basis for expenses is 1.2 lakh rupees, which he wants to service through SWPs or systematic withdrawal plans. First of all, Vishal, what do you think about this approach? I don't know what his total corpus is, but how should he go about doing this?
So a few elements that I would suggest for him. One is that clearly the SWP requirement is going to evolve over a period of time because inflation is going to hit that 1.2 lakhs number, and therefore every year he'll have to go back and look at how that number needs to go up to account for inflation that may be happening as well. And obviously mutual fund SWPs allow that flexibility because you can increase that SWP at whatever point you need to. So I think a couple of recommendations for Mr. Manoj Gupta. One is that there may be a need to divide those funds into buckets. Maybe for the next 2 to 3 years of expenses, he looks at pure debt funds where there is no risk of how markets behave while he's doing this SWP. So typically a fund in the short-term debt fund category could be an option. He then looks at balanced advantage funds, maybe for those withdrawals which are between, say, 2.5, 3 years, all the way up to 6 to 8 years. And then he looks at equity for the period beyond that, so that as an overall basket, he's now able to get withdrawals happening from different pockets. And what he might choose to do is the equity component and the balanced advantage component. He may decide not to do any withdrawals in the initial stage at all, but just do it after those periods of time to take care of any volatility that typically gets exhibited when you go to equities.
That's a fair point. Any schemes that you would suggest that he look at?
So I think on the short-term debt fund side, typically an ABSL short-term debt fund could be an option. On the balanced advantage fund side, he could look at either ICICI or HDFC. And on the longer-term bucket, our suggestion is to use one index fund, maybe UTI, and maybe a Parag Parikh in addition to that. So probably about 5 funds coming together should be able to solve these problems.
Okay, so that's an interesting. Do you have anything to add to this, Mrin? Would you approach this differently? We have about a minute.
So yes, I mean, if he cannot take the risk, it's okay. But whatever Vishal has suggested is also very good. But yes, if he cannot take risk and he's not willing to take risk, then he'll have to do this bucket strategy where whatever he needs in the next 3 years is going to be in ultra short term and the balance is going to be in short term funds. So that's the only alternative that I can give if he doesn't want to take risk.
Okay, but if he wants to put a component into equity, would you suggest, as Vishal has pointed out, a combination of balanced advantage plus equity?
I would only suggest balanced advantage given his age. So, and given the fact that we don't know the rest of his corpus, I would say balanced advantage.
Okay, and any schemes that you like in the category?
ICICI is a good fund, and on the short-term side, again, ICICI or HDFC or SBI.
All right. Now, there are a few more questions. Unfortunately, we're completely running out of time. Vishal as well as Mrin, thank you so much as always for taking the time and for the insightful suggestions and explanations that you've given us today. Always a pleasure. And that brings us to the end of this particular edition of the Mutual Fund Show. If you've got questions, you see the number on your screen. You can send them to us and we'll take them over the course of the coming days. Do stay tuned. Lots more coming up over the course of the day. And this is NDTV Profit.